Hello students, welcome to today's session. I am Dr. Poornima J, Assistant Professor, Department of Professional Accounting and Finance, Krishna Jayanti, deemed to be University, Bangalore. In this video, we will be discussing an important concept under GST, which is Input Tax Credit, commonly known as ITC. This topic is very important for understanding how businesses reduce their tax burden legally. Let's begin with an overview of input tax credit. So, what is input tax credit? Input tax credit or ITC refers to the tax that a business pay on its purchases. This tax can be used to reduce the tax liability and when the business makes a sale. In simple terms, businesses can be claimed credit for the GST they have already paid while purchasing the goods or services. This helps avoid double taxation and reduces the overall tax burden. Let us now understand the major principles of input tax credit. First, credit is allowed on taxes paid for the purchases that are meant for resale. Second, the credit is also allowed on the other businesses related expenses. However, personal expenses are not eligible for ITC. Also, the goods or services must be used or intended to be used in the course of businesses. Now, let's understand input tax credit with a simple example. Imagine a manufacturer buys your raw materials worth of rupees 1000 and pays rupees 180 as a GST on it. This 180 rupees is called as a input tax credit. Next, the manufacturer produces goods and sells for rupees 2000, charging rupees 360 as a GST. This 360 rupees is called as output tax credit. So now the manufacturer does not have to pay the full amount of rupees 360 to the government. He can deduct the 180 rupees which is already paid as a input tax. So the tax payable becomes rupees 360 minus rupees 180, which is rupees 180. This is called as input tax credit. In simple terms, ITC ensures that tax is paid only on the value added and not on the total amount again. This helps avoid double taxation and reduces the tax burden on businesses. There are certain conditions that must be satisfied to claim ITC. First, you must have your valid tax invoice or debit note issued by the registered dealer. Second, the goods or services must have been received. Third, the supplier must have to pay the tax to the government. Fourth, the supplier must have filled the GST returns. Also, if payment is not made within the 180 days, the ITC claimed will be revised along with the interest. Further, ITC must be claimed within the 1 year from the date of invoice. And lastly, ITC is not allowed if depreciation has been claimed on the tax of component of the capital goods. Now, let's understand the apportionment of input tax credit. If goods or services are used partly for the businesses and partly for the personal purposes, ITC is allowed only for the business portion. Similarly, if they are used only for the partly for the taxable and partly for the exempt services, ITC is restricted only to the taxable portion. This ensures the fairness and proper utilization of the credit. Now, let us understand how to utilize the input tax credit for payment of different types of GST. To pay IGST, a taxpayer can be use the input tax credit available from IGST, CGST and SGST paid on purchases. To pay CGST, the input tax credit from IGST and CGST can be imposed. Similarly, to pay SGST, the input credit from IGST and SGST can be utilized. This system ensures the proper adjustment of the tax credit and helps business reduces the overall the tax liability in an efficient manner. Let's look some cases where ITC is not allowed. Motor vehicles are not eligible unless they are used for the transformation businesses, or training purposes. Also, goods or services used for the personal consumptions are not eligible. Additionally, goods or services under composition schemes are not eligible for ITC. Further, ITC is not allowed on the work contract services used for the construction of immovable property. Goods that are lost or stolen or given as free samples are also not eligible. Expenses like club membership, health and fitness services, and employee travel benefits are also not included. Also, ITC cannot be claimed after the specific time limit. Let's understand the time limit of claiming the ITC. ITC must be claimed within the 1 year from the date of invoice. Alternatively, it must be claimed before the September following the end of the financial year or before filing the annual return, whichever is earlier. This makes it very important for the businesses to track their invoices carefully. To conclude, input tax credit is a key feature of GST that helps businesses reduce the tax liability, and it promotes the transparency, avoid the cascading effect of taxes, and ensures the smooth tax flow in an economy. Understanding ITC is essential for proper tax planning and compliance. Thank you so much for your attention. I hope this session helped you to understand the concept of input tax credit clearly. Thank you.